the next example, what I'm going to do is I'm going to use the same problem, but this time I'm going to use a different method of depreciation. I want to see what effect is going to have on my rate of return here. So this is example 17.3 here. This time I'm going to use modified accelerated cost recovery system. In previous example, we used the straight line method. So this time we're going to use modified accelerated cost recovery system. Same information as previous example. Now, in modified accelerated cost recovery system, the depreciation is very simple. We are going to assume this equipment is a 5 years classification. So if you go to table 16 in your book, in page 437, you're going to find the percentage. So I'm going to show you the percentage for you. For year one, the depreciation is going to be 20% of the first cost, which is 15,000. Again, this is the same example as example 1 and 2 here. The only difference, I'm using a different method of depreciation. So this is going to be 3,000. And for year 2, again, those percentages come from the table 16 too. 32% times 15,000 is going to be equal to 4,800. For year 3, 19.2% of the first cost. And that's going to be equal to 2,880. And for year 4, it's going to be 11.52% times 15,000 is going to be equal to, and it's going to be 1,728. Now, pay attention. Year 5, under this method, we're going to cut this one in half because the first year was half a year. The last year should be half a year. So that's why we're going to use 5.76% times 15,000, which is going to be only $864. Remember, from year 1 through year 3, we use DDB, double decline balance. For year 4 to 5, we use a straight line method. You're switching. That's under modified accelerated cost recovery system. Now, if I add this summation, this is going to be the summation of dt. T goes from 1 to 5. This summation is going to be equal to 13,272. So this is how much you're going to depreciate. But remember, the equipment we purchased, the first cost, it was 15,000. And the salvage value, it was 4,500. If I find the difference between P and salvage value, it's going to be 15,000 minus 4,500 is going to be 10,500. Pay attention. You're only allowed to depreciate 10,500, but you depreciate a little more than that, 13,272. If I subtract these two numbers, so 13,272 minus 10,500, then you're going to get 2,772 here. Basically, you purchase the equipment for 15,000 and you sell it for 4,500, but you're depreciating under a modified accelerated cost recovery system up to 13,272 here. It means you're depreciating a little more than you're allowed to by this much. This one, we call this one capital gain. So it means you recapture some of your depreciation. So we're going to include as a capital gain when you calculate the taxable income. So which I'm going to discuss next. So we're going to continue example 7.3. So what I'm going to do, as usual, I'm going to draw the table. So this table is very useful. So this is the best way to do it. This is year. This is before tax cash flow. The next one is the depreciation. This time you're going to use modify accelerated cost recovery system. Then we're going to have your taxable income. Then we have the taxes. Again, we're going to assume the same rate to apply. So 34%. And then the final column is called after tax cash flow. So this is year 0. 1, 2, 3, 4, 5, 6. Oh, actually 5. We have only 5 years. So we're going to have initial cost 15,000. There's nothing here. So actually this one should be negative 15,000. Now the income is the same as before, 4,000. So 4,000. So that's your income. And the last year is going to be 4,000 plus the salvage value, 4,500. So this is just information based on the data for the example. Now we're going to find the depreciation. In the previous part, I asked calculate the depreciation. I'm going to include here. So the first one was 3,000. The second one was 4,800. 2,880. 1,728. And 864. Now what we're going to do next, we're going to subtract this column from the first column to find the taxable income. So this is going to be equal to 1,000. This is going to be negative 800. And this is going to be positive 1,120. And this is going to be 2,272. Now, for year 5 is a little tricky. So I'm going to show you how you find the taxable for income for year 5. So I'm going to write this one here to see how we're going to. Your taxable income for year 5 is going to be this. This is for year 5. Because you have to include the depreciation. So first of all, as usual, 4,000 minus 864. That's the difference between your income and your depreciation. So what we're going to do here, we're going to add 2,772. Why we are adding this? Because you depreciate a little more than you're allowed to. So you're allowed to depreciate to 10,500, but you depreciate up to 13,272 because it's on capital gain. So you have to pay tax on it. So it means your taxable income for year 5 is going to be equal to $5,908. So that's why I did this one separately. It's different from previous years. So it's going to be $5,908. Now we're going to find taxes. So 1,000 multiplied 34% is going to be 340. Now, you might say, I have negative income. Still, you have to do it. What happened here, this is a capital loss here. Basically, you can recover this in future income. So that way, we're going to put this one as a positive. So this is going to be, actually going to be negative 272. When we do the taxable income, we're going to add to this. So this is going to be equal to 380 and 80 cents. It's going to be 772.50, 2008.7. So what we're going to do next, we're going to add or subtract this column from previous column. So when we subtract this negative, negative is going to become positive. So first year is going to be 3,660. The next one is going to be 4,272. Year 3 is going to be equal to 3,619 to 0. And year 4 is going to be 3,227.50. And the last year is going to be $6,491.30. So that's basically your cash flow after taxes. So once we do this, we're going to come up with the rate of return equation and solve for I. 17.3. So in previous parts, we came up with the after-tax cash flow. So I'm going to represent this cash flow here. So the cash flow for after taxes is going to be like this. Initial cost 15,000. That's not going to change as before. Then year 1, 2, 3, 4, and 5. So again, in this case, you will see that it's not going to be uniform or any pattern. So it's going to be different. So it's going to be 3,660. Year 2 is going to be 4,272. Year 3 is going to be 3,619.20. And year 4 is going to be equal to 3,227.50. And year 5 is going to be 6,491.30. Obviously, this is not any uniform payment. You have to do this one individually. So what you have to do here is this. Present worth of revenue minus present worth of cost equals 0. So you have 3,660 at the end of year 1. So you're going to multiply this one by P given F for 1 year. I is unknown for 1 year. Then you have the next one, year 2, which is 4,272 times P given F, I and 2. The next one is 3,619 and 20 cents. You're going to multiply this one by P given F, I and 3. And the next one is 3,227 and 50 cents times P given F at I and 4. And the last one is $6,491.30 minus 15,000 equals 0. So it's a huge rate of return equation. So what you have to do here is you have to guess it. So again, in this one, I'm not going to do it because it's just it's tedious to use in the equation. So if you can use software or then you can solve for I here. So I'm going to give you the result here for this example. The rate of return for this one, this is after tax. So it's going to be about 11.96%. Again, if you remember from example 17.2, the rate of return, when I use the straight line method, it was 11.15%. When I'm using the modified accelerated cost recovery system, it's 11.96%. So you can see there's a major, there's a significant increase here. Why is that? Because when you are using modified accelerated cost recovery system, you're depreciating more at the beginning rather than at the end. So that way you save a lot of money, so your rate of return is going to go higher.